solving your China business pain points. My name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. And in today's episode, we are going to be looking at the qualifications for China's pre-tax super deduction for R&D expenses. In March 2023, China's tax authorities extended the policy of pre-tax super deduction of R&D expenses indefinitely, making it a permanent preferential policy for all types of companies in China. The super deduction policy allows companies a 200% pre-tax deduction of the expenses incurred in conducting R&D activities that do not form intangible assets. The policy means that a company that incurs 10 million RMB in R&D expenses in a given year can deduct 100% of the expenses incurred in addition to the pre-tax deduction of 10 million RMB that it would already be granted by law, amounting to a total deduction before tax of 20 million RMB. This will result in a considerably lower profits tax payable for the given tax year. Now, R&D expenses that lead to the creation of intangible assets can be amortized before tax at 200% of their cost, with no time limit placed on when the intangible assets are formed or amortized. While the policy has gradually been extended to all companies in China, save those operating in certain restricted industries, the type of R&D activity that a company can claim is still subject to certain eligibility criteria. It is actually this exact scope that has sometimes been difficult for both companies and the tax authorities to assess, resulting in confusion, disappointment, frustration about the implementation of the policy. Now, in order to help companies assess whether their R&D activities are eligible for the pre-tax super deduction, the State Administration of Taxation has compiled several case studies of companies that successfully or unsuccessfully applied for the deduction. The case studies also explain the reasons for the acceptance or rejection of an application, providing valuable context for the application of the eligibility criteria. Now, what I want to highlight is that in announcement 119, in order for the R&D expenses to be eligible for the super deduction, they must have been spent on systematic activities with clear objectives that companies continue to carry out, acquire new scientific and technological knowledge, creatively apply new scientific and technological knowledge, or substantially improve technologies, products, services, as well as processes. In this same announcement, it clarifies that expenses on the following activities are not eligible for this super deduction. One of them is research in the social sciences, arts, or humanities, routine quality control, test analysis, repair and maintenance, or when these activities act as part of the industrial process, market research, efficiency research, management research, duplication or simple changes to existing products, services, technologies, materials, technical support activities that companies provide to customers after the commercialization of the product, the direct application of a scientific research result, and routine upgrades of products and services. Okay, so that is not eligible. Now, this is supposed to be a short video solving your China pain points. So I just want to outline questions that you should be asking yourself to understand whether you fit the criteria. The first one is, has the company outlined clear project R&D objectives? 2, are the R&D objectives sufficient? And how can you prove that? 2, are the R&D objectives sufficiently innovative? Are there breakthroughs in innovation? And how do you prove that? Has the company outlined the core technologies and technological innovations that it will use and aim to achieve? And again, how do you prove that? Are the project's proposed technologies and processes sufficiently innovative? Has the company set clear project milestones? Did the company outline a realistic development roadmap for the project? Do the R&D outcomes carry uncertainty? Has the company provided supporting documentation, as mentioned? And finally, again, the above evaluations or the above criteria questions that I've highlighted are made with the context of the current level of technological advancement within any given industry within China, which is always going to be subject to change. An R&D project which is considered to be making breakthroughs one year may therefore no longer be considered innovative next year, especially if it has already become established within the industry in the meantime. It is therefore important for companies in China to consider the current level of technological development within their industry when considering which project may be eligible for this R&D super deduction. We hope today's video is helping, and we certainly welcome any questions or doubts. So we're providing you a link to our diary, and feel free to sign up for a 15-minute free complimentary call to see if we can be of assistance. If you want to learn more about what we do at Woodburn Accountants and Advisors, head on over to our website. It's woodburnglobal.com. And last but not least, please do share and like our episodes. Our mission is to help as many foreign investors, entrepreneurs, leaders become successful in the Chinese market, but more importantly, also protect their businesses. Have a wonderful day. Take care and goodbye.